Hello, welcome everybody, and thanks for joining us today on this webinar, which is a hot item, active versus passive, right? It's a very, it's a good topic too, and I think we're gonna have a really great debate, more insights. But my name is Athanasios Psarofagis. I am ETF analyst with Bloomberg. I'll be moderating this panel, and I'm glad to say we're joined by some great panelists and leaders from the investment community. We'll do some brief introductions in a little bit, but I just want to go over some housekeeping items because we've had some questions already about this, and then we'll dive into it. Firstly, this is going to be recorded, so if anyone will like a copy of this, I think there'll be some follow-up emails about this. If there's anything that you miss, don't worry, you'll be able to backtrack. Hopefully at this point, everyone has used Zoom. But if not, there is a Q&A box. Feel free to enter any questions that you have as we're going through it. We're going to allot some time at the end to address those. Some things about our sponsor, Evenco, that they have going on today. There is a live event in Spain happening. And then anyone who was recently at the Chicago CFA event, they were there highlighting some of their analytics and fund flow tools. If you have any questions about Evenco, just feel free to follow them on LinkedIn. It's Evenco Analytics. They're pretty easy to find. But just on today's topic, obviously what we're going to go over is this growing trend of passive, right? And sort of what impact that has on the evolving roles of portfolio allocations of the investment managers. There's always questions that come up about market concentration, AI. So hopefully we'll be able to get to all these topics. But with that, let's do some brief intros for each of our panelists. Maybe Daniel, we'll start with you, and then we'll go around.
Great, thanks. I'm Dan Kern. I'm the Chief Investment Officer of Nixon Peabody Trust Company. Nixon Peabody Trust is the wealth management subsidiary of Nixon Peabody, which is a global law firm with 650 or so attorneys with a footprint in the US, Europe, and in Asia. It's a real pleasure to be here. We handle about $4 billion for 500 clients, and this is a topic that's near and dear to my heart.
Great. How about Matteo?
Hi, my name is Matteo Fornasier. I work for BBPM life insurance company. We distribute mostly in Italy. We manage 4 billion, a little bit more, an asset under management in the industry for almost 20 years.
Great. Colin?
Yeah, hi, Colin Graham at Robeco. I head up the multi-asset and equity solutions at Robeco. Spent 25 years doing multi-asset and blending the active and passive together in order to give the clients the best value for money.
And Christoph?
Yeah, hi. So I'm Christoph Kaspar. I'm the global CEO of Edmond de Rothschild Asset Management. So we have about $100 billion of assets under management with a global footprint. I spent before that 17 years at Russell Investments, where I was for 8 years, global CIO multi-assets. So I did, at that time at least, a lot of passive active on investments.
Yeah, that's great. So we'll have a lot of great insights and obviously a lot of great industry experience. Let's dive into it. We'll start at the highest level and then maybe work our way down. But obviously, while we're doing this, it's not a secret. Passive is growing, right? Whether it's through ETFs or funds. I guess I'm just curious how that growth is reshaping or can reshape, say, the role of the active manager and maybe what role active plays in the portfolio. Colin, let's maybe start with you, and then everyone else, feel free to dive in.
Sure. So the way we think about this is there's risk budget to be had for allocating to active managers versus passive. And so you want to allocate to regions or indeed assets classes where you think the alpha content is highest. So very simply, you can just rank an index or an ETF versus the active peer group and just see where that comes up. In the US, you're going to find that you have a 1 in 4 chance or 1 in 5 chance of picking an active manager that's going to outperform the index. But if you go to Asia Pacific or indeed high yield or some various other areas, you'll find that your chances of picking an active manager that's going to add value is much, much higher.
The way that we frame it, and I go back to my days as head of asset allocation for Charles Schwab's investment management business. At one point in time, when I was running target date funds for them, it was a novelty to combine active and passive. Now, as a client told me earlier this week, that's everybody does that. I found historically, to Colin's point about risk budget, I found that it's helpful to have a framework to work from, and a framework to help you identify where to take active risk and where to let the market do the work for you. And we've basically used a framework in which we think about the probability that an active manager will outperform. And in U.S. large cap, I think that's a well litigated topic. And over time, it really pays to be in either index ETFs or in a direct indexing strategy. The second part of the framework is payoff. Do you get paid for winning? So it's one thing to have a probability of success, but is it worth it to take the extra risk and the extra cost in order to derive maybe a small return from winning in active management? And then third, it's persistence. And I go back actually to a research study that Frank Russell did years ago, a couple of decades ago, where they looked at persistence among institutional investors from one 5-year period to another. And what happened often was that the winners over the last 5 years are usually the losers over the next 5 years. And oftentimes the top quartile managers found themselves in the bottom quartile. And so that performance chasing is definitely something to avoid. So if you have positive probability of outperforming, followed by a reasonable payoff from outperforming and persistence in outperformance, that to me is the recipe for seeking active management. And in parts of the market like US small cap and in high yield fixed income, those three P's, probability, payoff, and persistence, lead to leaning into active management.
Yeah. No, please go ahead, Christoph.
Yeah, sorry, I was trying to jump on what I think Daniel mentioned, quoting my ex-firm, on Russell, which is interesting because ultimately, on top of risk budgeting, which I think clearly is a way to look at portfolio construction, I would also add in the debate the fee budgeting. Ultimately, and that reminds me from my time at Russell, which when you have the resources to do managed research on a very large scale, you actually just need to avoid the bottom performing quartile manager. And that's actually true in every asset class. It's true that the alpha capabilities that you can have in Japanese small caps, for example, is much higher because the market is less well covered, and there's more inefficiencies. But actually, even in US equities, if you're able to avoid the bottom quartile active managers, you will find out that the 3 other quartiles left are still on the median, will beat actually less, but will beat on a regularity on a 3-year rolling basis quite regularly the general index. So I will put it slightly differently. I'd say depending on where your resources are as a multi-asset or manager selection person, you may want to dial up and down where you take your active risk from a risk budget point of view, but also I do believe you can actually do a fully active multi-asset portfolio. Just be aware that on US equities, the net of fee alpha can maybe be 25 or 50 basis points, whereas actually in global emerging market or Japan small cap, you can be 2%. The question is, do you have the resources to pick up the right managers, yes or no?
Yeah, that's a great point, because obviously we cover ETFs, and I think some stuff I wanted to say what you were saying, Dan, is there's more active ETFs than passive in the United States. A lot of people don't realize that, right? The assets aren't the same, and then to Christoph's point, because the ETFs are so cheap, and let's say they've saved you a lot of cost in your core, it allows that fee budget to go maybe chase some of these other alpha seeking strategies, right? And still keep your overall cost down. But Matteo, jump in if you maybe if you have some insights on areas that you have seen active maybe have a little bit of a better chance or some better beat rates in whether it's small caps, EM, thematics, things like that?
No, yes, thank you, Athanasios. I start, in my opinion, there are two aspects. First of all, let's start from, we start always from the client. And I was discussing this morning with the group risk manager about the reduction in yield to develop a product that is cost efficient for the client. So having a product, having many counterparties involved in a life insurance product. I work in life insurance, so there is the insurance company, the distributor, we need to, and then the asset manager, if we delegate an asset manager, we need to take care of paying a little fees to everyone. So being efficient from a cost perspective is always important. Active tend to be a little more costly. So my second component is that I can build easily core portfolio with passive investment, cheaper, and then try to generate better value, an extra value with an active component, with a satellite component of the portfolio. Trying to improve efficiency in the overall construction of the portfolio and thinking at the client first, I think is a right combination. So based on as well on what you said at the beginning, active and passive can live efficiently together.
Yeah.
Totally picking up on Matteo's point there. There are certain factors within equity markets that have shown they add value. So if you think of value, momentum, quality, low risk, through time, these factors generate alpha. So the research that we've done recently said, well, if we use these factors in our quant process and we add a fundamental high conviction alpha portfolio to that, you actually get a much better risk adjusted return from that than just doing active versus passive.
I guess for all you, have you seen that role change? Meaning, was it before active was trying to replace, let's say, the core, and now it's just evolving to be more just living alongside like passive in the core and learning to live more as like a satellite position than maybe necessarily a bigger part of the core?
I think if I may jump in, I'm jumping from what you say and also to what Colin said before. I think 22 shocked the many market players. And I must say market players, I think, shocked more the clients even than the asset managers, in the sense that I remember very well that in September 2022, at some stage, a 60-40 had a minus 17 or 18% drawdown, with correlations being actually very high between bonds and equities. And I think that didn't happen since 1937 or around that. And I think that created for clients in general, and especially distribution clients, an extra push towards core being safe. So you can do it in a passive way, or going back to what Colin mentioned, what I call almost a quantamental approach, which is a lower risk portfolio, still active, but lower risk, with satellite approaches. Because people don't want surprises anymore, and they want a core where they know that the outcome will be plus minus 1% or whatever, okay?
Yeah.
Or close to zero if you think of ETFs minus costs. And I think that's been a shift in mentalities, was before, the core satellite discussion, yes, existed, but I think multi-manager could well create portfolios only made of satellites, but with very low correlations.
Okay, that's really interesting. I like that about saying, just more about reducing uncertainty. But let's talk a little bit maybe more about 2022 and just like shift asset classes about fixed income. And maybe what do you guys sort of think about active in bonds versus active in fixed income? Do you take a different approach? Do you view it any differently?
I struggle with using index investment in fixed income. And I just think at the basic fundamental in equity indexes reward success, or they at least reward stock market success. That's not always a great thing, but it's generally a good thing. Bond indexes really are steered towards those that issue the most debt. And if I think back to U.S. high yield in the mid-2000s when you had problems in the oil patch. During that period, energy CFOs were using the high yield market as an ATM machine. And so the indexes were really dominated by energy debt. That didn't end well, nor did for non-US fixed income, nor did it end well during the European debt crisis when Portugal, Italy, Ireland, Greece, and Spain were 22% of major indexes there. And so I lean against passive management and fixed income pretty much universally.
Actually, we have a question which I think could we maybe from the audience maybe ties into this, but has to maybe do more with like the macro backdrop. And sometimes you see these stats, well, active does better in market uncertainty or down markets. Do you think that's true? And does that maybe change your viewpoint on the balance between how much to use between active and passive?
I think there has always been cyclicality in alphas. That's been the case for the last 25 years. So alpha is actually cyclical as a whole, and you just need to look at quartile charts and benchmarks. I think the recent period, when I say recent, probably this 2, 3, 4 last years, has exacerbated the stress between short-term returns on long-term investments, which meant that many alpha-driven managers, due to market concentrations on the very big bounce up and down of markets, have been caught because they've been trying to chase the recent performance, and that's the difference between price and valuations or price and value. So I think cyclicality in alpha has been there forever. But as an active manager, and actually back to where I work now, we do believe 100% in active management. You just need to be very focused in how you do it and keep a very long-term time horizon in your mind.
Yeah, and just coming from a slightly different angle that Christoph sort of mentions here, I'd go back a bit further and say that coming out of GFC, you saw that liquidity was abundant, and therefore the amount of money that came into the system basically found its way into assets. And in that way, basically, the tide comes in and all boats get lifted. As Warren Buffett says, when that liquidity tide starts to flow out, you're going to see who's swimming naked. So passive has ridden that crowding out of the alpha generation, looking at the data from companies, because people just buy the index because they have money. Yeah. If you start to turn that around and say, well, actually, liquidity is going to be harder to come by over the next 10 years, then that's where you might see the alpha, the active versus passive argument start to shift slightly.
My consideration, in particular in relation to the fixed income, is that if we start from an equity perspective, or we want to acquire a company, gain a larger part or larger stock of the company, so we are an active investor for a different purpose, then passive makes sense for most of the investor. We're talking about large cap, large index. While for fixed income, there are different dynamics. There are insurance companies that need to hold asset in the portfolio. There are retail investors that want something safe. So I understand the average Joe in Germany maybe is happy to have the Bund in the portfolio because even though the yield maybe is lower, but then it's safe, is living in the country. Like I'm Italian, a lot of Italian people, like my family, they own Italian government bonds. So active in the fixed income, it still can have a positive edge, because maybe I can, speaking very easily at the European content, I can increase maybe something with a slightly more yield, like Italian in this moment, or Spanish bond or Portuguese bond, reducing a little bit the German one, staying close to the benchmark, or take a properly active approach, but still generating an extra yield, which, considering the fixed income world, yield are not so high, it can provide just that competitive advantage. Keeping in mind everything needs to be proportionate.
Yeah. Let me ask you another question. Maybe this is more philosophical, right? And we get this a lot too, about the line between active and passive, right? And we see this a lot of stuff that's being launched either through ETFs or new strategies, whether it's, you want to call it smart beta, rules-based factor, right? And maybe it's an index, but it has 15 inputs. Do we count that as active? Do we count that as passive? Where do you guys start to draw the line, or is it becoming very blurry about what is actually truly passive, what's truly active, and what's that middle ground look like? Just curious on your thoughts.
Well, well, jumping in, I think anything that is not the index is an active decision. So, smart beta started forgot when, but at least 15 years ago. So when people say, "Oh, is that the holy grail?" Well, the truth is, just betting on one factor, and if you don't have a skill in updating that factor or being actually smart in how you actually choose companies, based on XYZ factor, what you just create is volatility. Because just sitting on the factor, yes, sometimes the factor will work, sometimes it won't work. Is there any factor that in a very long term, we persistently do well? I think that's against capital market efficiencies. So the answer is it's active management. It's a quant-based rules. It needs to be updated and reviewed from time to time, and you need to have skill to start with in actually deciding how you put together your portfolio in betting on a certain factor. And the only difference is that the risk budget, it's very low. It's not, multi-factor, high-octane quant is probably less factors, maybe not single factor only, lower tracking or strategy, but it still needs to be actually thought through carefully.
And philosophically, I like factor-based strategies, but it's very important that you understand what you're buying, understand the factor and when the factor tends to do well, and understand how the factors being applied. There are many different ways to define quality. There are many different ways to define value. And there are many different ways to create a portfolio based on the value or the quality factor. And so I've seen strategies in the factor-based arena that range in expected tracking error from very low tracking error to very high tracking error. So that the devil, as always, is in the details. And too often, I think it's hard for mainstream investors to take a look and understand the difference between factor strategy A and factor strategy B. And it pays to do the homework necessary to understand what your experience is going to be.
I've been head of smart beta for a few years in the past, and I think the active component is the design part. It's active until you design the strategy, especially when we talk about volatility, momentum, more quant strategy. Then it becomes passive when you maintain over time. It become active, in my opinion, the activity of redesigning the strategy and evolving over time. But then I would consider the smart beta as mostly passive. Yeah.
Yeah, just to add to this point, I think that anything with a tracking error should be considered active. So if you go to a wealth management client, their benchmark might be cash. So if they buy an S&P ETF, effectively that's tracking error over their long-term objectives. So yeah, I think it's very blurred. And I think it also should come back to what the client's asking you to do, to say, can you actually replicate with zero tracking error what they're asking? Very rarely is that possible, and therefore you're automatically taking active management. And it's not just about stock selection, it's about the whole portfolio. And that's where we come from.
Yeah, so that's a fair point. Right? If someone buys S&P ETF, they're not, a lot of the time they're not just holding it forever. They're trading these passive vehicles, right? It's a passive, so they're very active in the trading. So yeah, it's a very blurry line. I don't know. I don't know where the line is, but obviously some of the new stuff that's coming out, it's complicating things. I've even heard rumors that they say, well, not rumors, but they're like, well, is the S&P 500 active because it's a committee, right? And they're choosing what stocks get put in, and it's not necessarily just market cap, but that's another whole nother debate. But let's talk about maybe the impact that passive has on the market, meaning, okay, 10, the top 10 names have X% of the index, they're getting much bigger. What are your sort of thoughts about, like, let's say, concentration risk? Maybe not only just if passive grows, its impact on the market, but then investors maybe taking outsized concentration bets on these few companies as well. Anyone can start. Dan, I guess I saw you shaking your head. Yeah.
Concentration scares me. Concentration's a great way to make a lot of money, but it's also been a way to lose a lot of money over time. So I think highly of a lot of the companies that have been in the Magnificent Seven in the U.S. and some of the big industry or the big index components outside the U.S. But you have a lot of money on the line when something goes wrong at one or more of those companies, or if sentiment shifts, and that concentration in the markets historically has ended badly. If I go back as a market historian, so it is something that makes me nervous. It also, additionally, with the proliferation of product, you get concentration often in areas that you don't expect to get concentration in. So I think it's well known that there's concentration in the S&P 500 or in the Russell 1000 index. Less well known is, I was looking the other day at a dividend appreciation ETF, which used to give, I think, a diversified investment experience from a traditional S&P 500 holding. And that dividend appreciation index is packed with some of the same stocks that dominate the S&P 500. So you think you're buying a diversifier, but you're really increasing your concentration risk in the S&P 500. So that makes me nervous. I buy some of the argument that the business models for some of these large index constituents is different, and there's a profitability and a growth consideration that is, that does justify higher multiple. But I'm physically nervous at the level of concentration.
Yeah. Well, I think exaggerated concentration is extremely dangerous. And actually, as an active shop, I feel with a long-term time horizon, I actually think concentration in a short-term pain, but a long-term gain for an active manager. If you keep a long-term time horizon, because concentration is created maybe by positive at the beginning by positive fundamentals of the companies, but then with active now or passive investment being so big, you keep on having money flying in the same companies. And it becomes bigger. It's a price game as opposed to a valuation game. And then at some stage, as you said, actually, Daniel, it will collapse. But as an active manager, there's a huge opportunity, in my view, if you really can hold the pressure from sometime management, sometime clients, and actually stick to your fundamental valuation models and actually play the long term. So for me, concentration is dangerous for the markets. It's actually an opportunity for active managers, as is the rise of passive.
I think it's important.
The rise of passive is actually, for me, as a proper active shop, very focused. It's actually a good news.
I think that, to amplify Christoph's point, I think that an active manager has the ability to see the inflection point in a business model. One of the things that I think was missed during the dot-com boom and then bust was that there was a transition point at which the makers of the picks and shovels for the internet that growth was decelerating and that margins were decelerating, and those that caught that inflection point were able to sidestep a lot of the pain. And to your point, having that valuation discipline, I think that moment in time now could be the time at which some of the spending from some of these big leaders, it used to be that for every dollar of incremental revenue, some of these companies would have maybe 3 cents of incremental costs. With the spending necessary to support AI development, that marginal profitability dynamic may change. The incremental dollar of profitability may cost a lot more than 3 cents, which changes the profit margin picture, changes the logical valuation. The indexes won't see that, but a skilled active manager may see that and be able to embrace the business models that are going to continue to work while sidestepping the business models that may be compromised by what the next decade will look like versus the last decade.
Just to add to that point, if you think about what passive does well, it does well in bull markets. So when markets are going up, it's very difficult for active managers to keep up unless you hold the very high concentration of portfolio stocks. But as Dan said, Christoph, we're active managers, so we are looking at the sort of mid and small cap for areas, and the natural place you take your money from is those large caps in the index. So they do well in that period. So if you have long bull markets, passive will take the lion's share. But at turning points at the top and the bottom, and in bear markets, active managers who will hold cash should outperform passive index funds.
Yeah, and maybe if I just jumping on what just Colin said, I think what is very true is I sometimes hear people saying, well, we run a large cap portfolio. I think unless you are, gigantic in assets, okay, and actually none of us in the room here are gigantic in assets, well, you shouldn't have to be only in large caps. I liked when I was at Russell, I like when the way we are here at Rothschild and among the Rothschild to run all cap portfolios, because the fact that you can actually move around and go in mid caps is a competitive advantage. Even so, yes, you have maybe alpha cycles in the short middle term that can be tricky, but that's where you can add value. And actually, that's where I'm very optimistic for managers, which don't run trillions, because many people say, well, asset managers, there's consolidation, and you have to have trillions under management to actually really do well. Well, I think that's a distribution game, but as an active shop, you can really do well with a few billions, 100, 200 or so on, because you have the portfolio flexibility to really, be opportunistic, where the super large shops, they don't have the liquidity or the capacity to actually go in these mid caps. They have to do some small cap portfolios, and then they're stuck into the small caps and take weeks to get out of it.
Going back to the question, I think that you don't put all the money in a single pot. You don't do it as an institutional, you don't do it as a retail. So it's important to be able to diversify and pick the investment strategy you want to pick. Obviously, there are concentration issues, in particular, Magnificent Seven, if we think about the US 500, or US market, if we think about a global index. But then it would be a mistake to focus only on a global index, don't diversify. You would have suffered over the last few months, in the past couple of months, and then maybe gain something back. But then it's always important to have a focused approach and thinking at the overall pot of investment and put a proper diversification. ETF are an instrument, and you have to always consider the pro and the cons, and the concentration issues is one of the cons that need to be taken care of.
Yeah, that's a great point.
Yes,
If I can go something.
There are
go ahead,
other risks. Yeah, there are other risks that aren't so well publicized here. And I'm picking up on Christoph's point where he says that the rise of passive provides a bigger opportunity for alpha in the rest of the market. I totally get that, but the rise of passive has also allowed the borrowing of the stocks to happen. So what do I mean by that? Well, the reason that passive investing can be so cheap is that they're providing stocks for stock lending out the other side to active managers and other people that need the stock. So they're getting revenues and fees from that stock lending, which allows them to bring their costs of manufacture down much, much lower. And so, that's a risk for investors that are investing in passive funds. And you have to be very careful about which type of passive funds you're investing in and what that relationship is.
Colin, I love what you just said because, like you, I was around in 2008 and stock lending, created some absolutely horror stories. And at that time, passive was a fraction of what it was today. I can't imagine today, if you go back into a massive dislocation in markets, what would happen to all the lenders, as you just mentioned. So I love that point.
Thank you.
Yeah, that's great. And something you said, Christoph, I thought was interesting about size, right? And does that eventually, do you see sometimes where that becomes a problem? Like, for example, if you're a small cap manager running a fund and the fund gets too big, let's say for that, does that start to affect you being nimble or what they can do? So I think that issue about size is really interesting. Like, maybe being smaller in certain area ends up being more beneficial.
No, I mean, definitively. I mean, if I want to oversimplify the asset management industry, I see two types of models. One is an investment-led model, and one is a distribution-led model. Distribution-led is basically an asset gatherers. You get the bigger, and ultimately, the bigger you are, the less active risk you take. And most of these shops have gone to do passive investment anyway, and do a lot of core strategies because they can't do anymore the proper active ones. But why? Because the investment-led guys, you can't be a monster to be investment-led because, there's an inverse relationship between asset size and capacity to do alpha. Well, maybe not in US equities where, the sky is almost a limit in terms of capacity due to the liquidity. But in many places, even emerging markets these days have become a lot less liquid. Becoming too big, you as a manager, you take weeks. I've seen managers in my past, I mean, hopefully not in my shop now, but when I was at Russell, who were taking weeks to get out of their positions. Yeah. Well, they had maybe 20 analysts covering that asset class, but you better damn made right that you were not wrong, because if you were wrong, you would take 6 weeks to get out of your position. So I really believe that, small is beautiful, or mid-size. I would rather say mid-size, because too small, a one-trick pony asset class, you have the risk to, if you really do badly as a business, you into the wall. But actually, when you are in a middle size, you can have, by being focused on a number of strategies where you are very careful about managing capacity to keep alpha as the key objective of what you do, you can have a really good, successful business model that actually makes money. Money for you and for the shareholders and for the clients, of course.
As somebody who allocates money to outside managers on behalf of our clients, in most asset classes, I'm looking to partner with investment-led firms that take capacity constraints seriously and are willing to close their strategy to new investors in order to preserve alpha. And I've seen time and time again over my 30 years of doing this, managers that get too big and they end up either not being able to get out of positions, or they end up gravitating towards larger companies or larger investment opportunities because they can't get enough of these smaller opportunities to really make a difference. So I think it's important to factor in capacity as you're thinking about hiring managers. The ETF structure, I will say, makes that capacity control a little bit more complex, because you can close a mutual fund to new investors, can't do the same thing with ETFs. We haven't seen that become a huge issue yet, but I think that's an issue that's coming.
But because maybe they don't care much about the performance, they just track an index. If you care a lot about the performance, as you said, then you go in soft closure. Bill Gross got stuck with Pinko and left Pinko because he didn't enjoy anymore playing with the fixed income market because it didn't have the flexibility that it used to have. That's an issue at a big level. Of course, that's another size, another issue. But then, especially, it was recently doing due diligence in a lot of small cap funds that we would like to add to our range of products. And I was chatting to anyone, especially with the fund manager with high conviction. They all have a size in their mind. And then if I go over for few million, it could be okay, but then they put the soft closure because it's then necessary. Otherwise, it's tricky. Being soft closure for a medium small asset manager is good because then you reach a good capacity and probably you're quite happy and probably you're not small anymore.
Yeah, that's and a great point, Dan. I know about the ETF, and it hasn't happened a lot, but there's been a few instances where size has become a problem for some of these, some index tracking ones, some active ones. I want to be cognizant of time, but I have a question on this, and there was actually a bunch of listener questions about AI, right? And it's it's a topic that obviously comes up a lot. And sort of, what are your thoughts on the role of AI with it, say maybe within the active selection process? Meaning, if there's not a lot of information on markets that we have today, can AI help maybe extract that information? Just sort of, what are your thoughts on AI's incorporation in active? Is it helpful? Is it detrimental? Sort of, what are you guys thinking?
Well, I suppose it depends. If AI could tell you that Donald Trump was going to tell people to buy stocks, which I don't think it could. So, there is this idea that markets are predictable, but they're not. And therefore, for us, AI is about the data management. We embrace it. We use it for data management. We understand the limitations. It's not forward-looking. It's only based on what you can feed it. But AI helps you do tasks faster and incorporates more data. So you're just doing things a lot faster, a lot quicker, using a lot more data than you used to. So this, to us, frees up our researchers, our alpha generators, to do more value-added work, whether it's the analysts, whether it's the researchers, whether it's the PMs. So this should help people that have edges and good investment track records. This is where you get the edge, and you can use AI to increase that edge over the rest of the market.
25 years ago was a fairly junior portfolio manager on a global equity investment team. I remember we had junior analysts that spent 80% of their time really gathering data and massaging data into spreadsheets that the more senior investors could use to make decisions. The automation in that space led to huge productivity improvements and a huge shift of how people were spending their time, really moving from data gathering to data analysis. I think we'll have another major leap forward with AI helping as a big productivity booster. But I think what's the old Paul Tudor Jones quote? No man is better than a machine. No machine is better than a man with a machine. And I think AI will be a turbocharged version of that.
So go ahead, Krista.
I basically agree with that. I think it's an enhancing decision-making tool, but when say enhancing decision-making tool, is that the decision is still taken by a human or by an algorithm that the human has created, because there's some fundamental theory why that quant process will actually detect an inefficiency that others haven't detected yet. Actually, it's like a quant process. Quant processes which are stale don't work long term, because it's about updating your research. And one of the questions I kept on asking in my old times, and I would do actually internally, is show me your research agenda when you're a quant investor. And today, when you do quant, you need to have AI to help you to work on data. And actually, even when you're a fundamental manager, you need AI to make you more efficient. That's what you just said, Daniel. But ultimately, the number one question is actually research agendas and the smartness, pertinence of that research agenda that will work on inefficiencies that others haven't seen yet.
On AI, I have three considerations, maybe a bit provocative, at least the first one. If we use AI to analyze financial statement or earning calls, it's pretty much useless because everyone can do that. BlackRock can do that, Russell, any asset manager, large or medium, probably even small. If we do it to analyze the opinion on social media on Temu, to buy Temu, for example, or analyze how many cars there are parked on Walmart's parking lots, then it can add some value. And there are some asset managers and try to invest heavily, but it's very expensive to get a good insight on this type of use of AI. That can be quite, I wouldn't say a game changer, but then can give a competitive edge. But that's very expensive. Only few asset managers can invest in that. What AI, in my opinion, can provide a good contribution is especially non-passive. Because if I have a physical replicating ETF on a very large index, and AI can help me to optimize the allocation because I cannot replicate the full index. AI can help me to replicate the allocation, improve the cost efficiency, so I can offer a more efficient product in terms of cost basis. Then that one can be really, in my opinion, a game changer, and it can be a very good contribution, in particular for the passive industry.
Yeah, so you're saying you see it useful as like setting asset allocation weights versus saying maybe picking stocks for you, like the AI being like your stock picker. Yeah. Because there's a couple ETFs that tried to do this. As you could imagine, ETFs try everything using AI to pick stocks, but it hasn't, I don't think it's been able to beat the S&P. So I think that kind of confirms a lot of your points. We actually have a lot of questions. I have more questions too, but there's only 10 minutes left. I want to maybe make sure we get to some of the listener questions, but I thought this was a good one that was asked, and it was about, as fund selectors, where do you sort of differentiate between something being closet indexing versus being like truly active when you're looking at it, and sort of where's the line there, being like, okay, this is actually active versus just trying to, copy the index.
We have so much data available to us. It's pretty easy to see when somebody's a closet indexer. Maybe a couple of decades ago, you could get away with being a closet indexer, but we can see through that fairly quickly, and I think that's true of everybody on the panel.
Agreed.
This next one, Colin, this one is for you, and sort of ask you, for your someone overseeing a multi-asset portfolio, how do you decide which asset classes are better suited passive, which ones are better suited active?
Yeah, that's a great question, and that's a question we sort of tackle every day when we're trying to construct portfolios. I just think it's where you think you're going to get the alpha opportunity. So, for example, large cap US, we don't bother. But if you go to emerging market debt, for example, then that's areas where you want to do the research to find an active manager in there. And then, in the other areas where it's less clear, then a mixture of quant and active really does help outperform the index, or indeed reduce your risk. So if you can reduce risk in one asset class, that means you can take that risk in another asset class. So if you've reduced it in emerging markets equities, you can actually take more risk in high yield because you're looking at the overall portfolio. And that's why I love multi-asset investing, because we can see across the whole spectrum and sort of pick out where we think the best risk return trade-off is.
If I may, because I do agree with what Colin said, but I would add one thing, which is there's debate on where you want to be active and passive, but as importantly is how you mix your different asset classes and where your uninterested bets are. Because what happens, any active manager has bets, factor bets in place, and beyond stock picking, and most stock pickers actually do factor betting as opposed to stock picking. That's a different story, okay? But as a multi-asset portfolio, you may want to take not only more risk, but you may want to be, betting on certain factors in certain markets because they may work better in that market, at least for a certain time, and do the opposite somewhere else. So what I mean is not optimizing each asset class on its own, is actually optimizing a total portfolio. That's very important. And I think that's as important as the question of where do you want to be active or where do you want to be passive.
Matteo, there's actually one question for you from the insurance side, and I think there was something you were mentioning about sort of predictability with passive and sort of they're asking, how do you weigh let's say the predictability of passive against like the potential for alpha with active when you're like sort of blending the two?
Insurance company, if we think about insurance company, we are quite risk adverse, of course. So the active component is necessary because we tailor the portfolio for our exposure needs. So, but that's a specific purpose. That's not for investing and gaining purely value, but there are other aspects that are involved. If we think about our client, life insurance client, then again, what I said at the very beginning of the call is a combination of the two, trying to get the best from the two typology. Passive, especially core component, more very efficient in terms of cost. Active on satellite component, try to provide a competitive edge on certain strategy.
It's great. Daniel, this one was for you, but I think everyone can chime in. I think it's a good question. It's obviously with low cost ETFs, right? Just a couple basis points. How do you communicate to someone, to not be swayed to say necessarily just go for the cheapest passive product and highlight the value of active, right? It's a good question. Sort of, how do you sort of talk through a client?
Yeah, the race to zero on expense ratios is definitely catches the attention of many clients, and really what we try to do is we try to show the potential return enhancement or risk reduction that comes from having active versus passive, and usually most clients are receptive to that argument. The other thing that comes into play too is we have to train clients to not just look at the expense ratio and to realize that sometimes the ETF with the lowest expense ratio isn't the cheapest when you factor in the total cost of ownership. So we try to reframe the discussion to be the total cost of ownership when we're talking about different passive vehicles, and the opportunity from active when we're talking about investing in something actively versus the passive ETF.
Yeah, we always trying to highlight that too. A lot of time, because they're so competitive. Yeah, maybe there's a 5 basis point difference in fee, but a 200 basis point difference in performance, right? And so whatever fee savings there are there, completely gets overshadowed. So it's obviously
and there's also ETFs that trade, at a really thin bid ask ratio, and some that don't trade as efficiently but have a lower expense ratio. There's also in my world, there's also transaction costs if you're at a custodian, and sometimes there's transaction cost differentials that come into play. That's more in the mutual fund world than the ETF world, but it can be a factor. So looking at the whole cost of owning something is where we try to steer our clients.
Yeah, fair. Let's do one more and then we can wrap it up. And I think, Colin, this is for you, was something that you had brought up about the liquidity tide going back out. I guess they're just curious, how do you maybe potentially see that? If it does, how do you see that playing out? What are some of the things that you're looking at?
Some of the things we're looking at is business models that have been put into place, or projects that have been put in place based purely on the amount of money that's been around. So, have these projects been started with an internal rate of return of 7-8%? If you do that, then you're like, okay, that's going to the interest rate of 5% now to refinance that is going to be pretty difficult. So for us, it's like you're thinking about that yeah, it's going to be the survivors, the companies with good business models, and that's why active management should be able to, and fund managers should be able to pick up that earlier than necessarily a passive fund that's based on an index.
Man, it kind of
Yeah, and actually, I think active management. I mean, we should not forget that active management has a very crucial role in capital markets. And if the whole world becomes passive, the simple function of capital markets is actually collapsing, because you need to have discrimination between the companies who generate future positive excess return on equity versus the others. And I think that's what scares me in actually a rise where passive goes too high up, creates massive market dislocation and volatility, and actually, drives down the capital available to sometimes smaller middle companies who actually need it to grow.
Yeah, no, that's fair. And you still need stock pickers in the market, right? Because it's a very interesting relationship with passive, because it's not like they decide, S&P decides, oh, we're going to make NVIDIA the biggest company, right? Active sets those weights. Passive just sort of rides on that. So I think it's a really interesting relationship. I think,
I'd probably disagree with you there. I think it's just people buying ETFs, because when
and
you
that's
buy
what's
the
pushing it
ETF, you
up.
buy the biggest stocks, and therefore the biggest stocks get bigger.
And it just keeps feeding into itself. Yeah, I agree. I think once it latches on, it starts to, it sort of just keeps snowballing.
Correct.
Indeed.
I think we were joking on the prep call that 1 hour wasn't going to be enough, and it's not, because we could keep going. But this was really great. We're at time. There were a lot of great questions, but I wanted to thank you guys, you gentlemen, of course. This was really great, really insightful, and thank everyone who joined.